Does everybody know your situation, Marissa?
Yeah, I think Rob mentioned it. Yeah, so,
Yeah.
yeah, for those of you who are new or don't know that I am expecting a baby pretty much any day.
Yeah, so we've actually got a little sweepstake on which presenter's webinar your waters will break during. So
Yeah, which who will break me? Yeah.
yeah, so I'm gonna try and amp things up here, see if we can get those waters broken.
No, I'm good. I'm good.
Right,
Let's try to keep it. I
right,
have till Saturday, at least till Saturday. We'll try to, keep this baby inside.
yeah, right.
All right.
Can you see my slides? Okay.
Yes, I can.
Okay, brilliant. Right, so I'll go ahead. Right, so what we're going to do in this webinar, we always like to do something a little bit different, and we're going to talk about, partly we're going to talk about trading targets. Let's just make sure my cursor is always on. Options, visible. Okay. First, we're going to talk about who we are and how we help people. It is important. Give you a bit of background. We won't dwell too much on that. We're going to look at traditional approaches to setting trading targets and some of the downsides of those. And obviously, generally, people put a lot less effort into targets than they do entering the markets. But when you think about it, the way you exit is no less important than where you get in. Now, I know at that point everybody wants to leave because I'm talking about exit, so we are going to talk about an entry as well. And we're actually going to give you a trade entry today, right? A completely free of charge trade entry. Targets make a huge difference, not just because a bigger target makes you more money, but because getting the most out of each trade means you make more money, but also you don't need such a high win rate, which in itself has a lot of benefits, like smaller drawdowns when you have a period of losses. So we're going to show you a setup used on the trading floor at Axia Futures in London by some of their traders, why it works, and also consider the management. So we'll give you an example. Now, if you've never heard of Axia Futures, we'll just give you an introduction. And it's a funny story because there's a lot in common with how we started and how Axia started. So there was a prop firm in London. I'm not going to name them. You probably know who they are anyway. And basically what happened, 6 of the really good traders at that prop firm in London. And a prop firm, if you don't know it, what they do is they'll take on people, sometimes people who've never traded before because they like to teach them fresh. Sometimes they'll steal them from other prop firms. They will give them money to trade and they will split the profits with the trader, right? So what happened was one of the traders tried to make a withdrawal. Now I'm talking about experienced traders that have been with this firm a long time and had built up a big account, right? I'm not talking about a couple of $1,000s. I'm talking about serious money. And one of these guys tried to make a withdrawal and he found out that his money had actually taken a permanent vacation. Now, I've heard 100 variations of the story, but basically this was a real bricks and mortar proprietary trading firm. The firm funded the trades and shared the profit, and at some point, one of those traders tried to withdraw some of their money and it wasn't there. And the other traders looked, none of it was there. And from what I hear, management were absent that day. And I will also tell you, there are a lot of the traders there who are Greek Cypriots. And so they're quite hot. And, the management were probably very wise to not be there that day. And the management kept their heads down. But if you can imagine the disappointment of trading for multiple years, building a sizable account, and then one day it's all gone. I mean, it's soul destroying, right? So basically what they did, 6 of the traders, they looked around and they knew they could make money, but they needed funding, right? Because all their money had gone. And they actually got funding from a very famous interest rate trader called Roger Carlson, who was very big in interest rates back in the days of the pits. And he owns a group of companies called FCT. So basically he funded the first 6 traders. And the first week that they opened that prop firm was the week before the referendum on Brexit, right? Now, if you remember what happened there, it gave us a lot of volatility. The British pound sank 10% against the dollar. Equity markets sank. But that team, that being their first week, that team capitalized on those moves. They made a lot of money that week. And that's still a big part of what they do now, looking for what moves the market and, capitalizing on it. And now they've got over 45 traders, some that work from the office and some that work from home. Now, while the traders trade their accounts funded by the FCT group, all prop firms have to have an education arm, right? They do like to take on people straight from university, and sometimes people that have never been to university, people that haven't traded before, because they don't have bad habits, right? So the education arm of this group that works from the same building, they own a building in London, is called Axia Futures, right? It's just a different company name for tax reasons, but it's in the same building and it's the same people, and it's headed up by a guy called Alex Hayward, and he's one of the original members of the 6 that started at FCT. Now, that education arm in a prop firm, it's not just about developing new traders, right? It's about the continued development of traders, right? Helping them with common issues, such as those that come when you increase size. So it's quite common for a professional trader, maybe he's allowed to trade up to 20 contracts, and they say, right, we're going to get you at 50. His performance will go down, right? It's just very normal, and you just have to get through that. And that's what Axia do. They help people get through those things. They help traders longevity so they don't burn out. And, they're always looking for ways to kind of to help develop traders and to work on traders' problems. And it's this arm that has helped Axia grow to 45 traders, right? And it's this company also, Axia Futures, that works with Jigsaw. So we actually provide you with some of the education that Axia produce. Now, I hope that's clear, kind of tells you who we are. Now, I'm not going to dwell on Jigsaw too much, but coincidentally, Jigsaw also started because a bunch of idiots lost 30% of my money, okay? So I knew nothing about investing in finance. I lived in Asia, where as an Englishman, I can't pay into an English pension. And so there were all these kind of expat independent financial advisors running around like little vultures looking for people like me who knew nothing about investing, and they lost 30% of my money. And at that point, I knew I've got to actually look at this myself. I would rather lose another 30% and not pay somebody to do it. At least I'm responsible. But I decided I would get into this. I started off the normal way with the internet. Found out pretty quickly that wasn't a really good place to look. And I was lucky enough to be traveling a lot in Asia. And so what I did, I went to a lot of networking events where there were professional traders, mostly in Singapore. If you know Singapore, that area around the Penny Black, Boat Quay, that area, events around there. And I met a lot of traders doing things I could never do, right? Because you needed billions of dollars. And I figured out what I could realistically focus on, and I got to work. And along the way, I was kind of dissatisfied with the way some of the platforms presented the information. And so I created my own tools. And just as a hobby, and people said, well, that's a really cool idea, you should sell that. And just as a hobby, I started Jigsaw. And we ended up with an award-winning set of tools, in-house education, as well as education from professionals such as Axia and Gary Norden. And we find that different techniques and markets suit different people. And today we're going to look at tools and techniques from Jigsaw and Axia that we believe will suit most people here today, but obviously not everything suits everybody. Now, part of what we're going to look at is targets. And there are some traditional approaches that people use to set targets, right? Most of them are there to address the same fundamental question, which is, where is it going? And really, we don't know, right? When you get into trade, it's like, I really have no idea where it's going to go. Now, some of it is situational, which we'll look at in a second, but these are some of the, the popular approaches. Where did that go? Sorry about that. Right, these are some of the popular approaches. So levels are the most common, setting levels somehow and getting out when it reaches what you consider to be a key level. And there's lots of ways people come up with levels. People use floor trader pivots still, even though there's no trading floor. People look at old highs and lows. But even with a high and a low from 4 minutes ago is very different from one that's 3 years old. Because a high and a low from 4 minutes ago, you could actually still have the same traders still in those positions right there, right? Now, it is true, if you look at things like index futures, there do seem to be a lot of reactions at yesterday's or overnight's highs and lows. So there is observable behavior on that specific market, and we shouldn't ignore that. But as observable as they are, does it make them a good point to get out of the trade? And we're going to see later why the answer is possibly not. There is actually a case for saying that makes them the worst targets. Then you've got math-based stuff, so stuff like Fibonacci, which many people swear by because it's something to do with the patterns you see in snail shells. It's something I've never really got. Other mathematical things like VWAP make more sense, as this has actually been a measure by which people filling large positions can say they got big prices. So let's say a firm needs to buy 1 million Apple shares. They're not just going to put a market buy order in for 1 million shares because they're just going to move the price and get terrible prices, right? But if they give that to a firm or somebody in their company that actually runs a buy program, they can measure the effectiveness of that person's buying over time by his ability to get average prices by VWAP, below VWAP along the way. So even though VWAP will change through the day, if he managed to keep getting in below VWAP, that means he did a really good job of actually filling that position. Okay, so VWAP is a number that has a Y. Fibonacci is snail shell patterns and leaves and stuff, and it's stuff like I have a difficulty understanding it. Other maths like standard deviations, very interesting. So when markets move certain standard deviations away from norm, you have a mean reversion strategy. It's actually better suited to spread trading and other mean reversion techniques. We probably don't have too many people doing that today. And then there's volume based, right? There's places where a lot or a little volume traded previously. So very, very popular right now. And in the short term, volume profile analysis does give you an idea of where positions might be sitting right now, which means that gives you an idea where stops are as well. But let's say you build a volume profile from the last year of trading, which a lot of people do, right? And they believe that somehow the market will react in the same place in a low volume node on a 1 year profile, today as it did 6 months ago. Now, I don't know about you, but I can't remember what I had for breakfast last Friday. So relying on the entire market to react in the same place it did 4 months ago through some kind of market muscle memory, that confuses me too. And then you've got candlestick patterns, very popular, but a little inconsistent. A doji on a 1 minute chart disappears on a 3 minute chart. But whatever you believe in, I'm not actually here to trash your trading religion. All I can say is that even the very best approach to setting a target has a single flaw that is going to be so obvious when I tell you later that you'll say, oh God, why didn't I think of that before? We will get to that shortly. Before we talk about that, there's another thing to consider, right? Something we call signal scope, right? You have to understand the scope of the potential move based on your reason for entering the market, right? So when you get into a trade, it's some kind of cause and effect relationship you're trading. So we believe there's a cause that will have the effect of moving the market our way, right? So let's say I took my 10-year-old to the driving range and gave her a 9-iron. I told her to hit some balls, and I spot Tiger Woods at the range and he's using his driver. Who's going to hit the balls the furthest? Hopefully not my 10-year-old, right? And it's the same with trading. Some setups like scalps are just little putts 5 yards from the hole that you take over and over again. You don't just roll up to a 400-yard hole in golf, take out your putter and try to get to the hole that way, right? It just doesn't work. So scalping produces signals that are frequent, but produce smaller moves, and that means smaller targets. Now, other techniques like trading into stops, like, when a range breaks, also create certain size moves depending on the market, right? Also depending on if you're in a range, the number of positions there, right? But when you're trading to stops, there actually might be a decent reason for continuation. Like, for example, if the stops are after a short-term range in a move up or in a pullback in a move up, then you've got a good probability of continuation upside. You're playing basically a pause in a bigger move. And then there's something like a news move, like Nancy or Donald or Brexit or Saudi, something that comes in, hits the market, pushes the market without any technical cause. Now, with that, it's not a technical move. So finding a technical goal is really problematic. In fact, finding a technical entry is really difficult because of the volatility it creates. So you end up scaling your way in. So each of these styles or setups have a different entry technique and a different expectation in terms of how far the market could run. Okay. Now, if we look at the way typical retailers look at the market, this is what a typical retail setup looks like, minus probably a few hundred indicators in some cases. So we've got levels, we've got Fibonacci's, we've got a few double tops that would have been double tops at the time. So this would have been a double top at one time. This would have been a double top at one time as well. Obviously they didn't hold. When you look back at a trending market with pullbacks, every pullback was a double top for a brief period, right? But when you look back and see double tops, they look very convincing. It's just you don't look at trends as failed double tops, right? So they look great in hindsight, but like I say, every move up after a pullback was a double top for a brief time. We just don't see them that way. Now this move up here is ugly, and it's probably an ugly move up where you might have kicked yourself a few times for bailing out on the way up because you thought it was failing. And what we also have in a chart is something that reinforces what I call left to right thinking, right? That the market moves from left to right. That in itself isn't a bad thing, but it actually causes a number of optical illusions. So if people trade at a specific point and we didn't move too far from it, there's a good chance that people who took positions there are actually still in that trade. So if you've got a lot of volume on the S&P and you moved up 4 ticks, the people who took those positions are probably still there, right? On the other hand, if we turned around somewhere 100 points or 6 weeks ago, there's not much chance that the people who traded there are still in, right? It's moved too far, it's been too long, it's forgotten about, right? But we seem to look at these levels as if they're equal, as if that high 6 weeks ago is equal to the high of the day. So what this is, it's like a superficial view that moves left to right, creates patterns, doesn't really give you a clue about whether people are still in positions, and it generates patterns because you plot any data over time, it will generate patterns. So for now, what I want to do is put the left to right view to one side and think about the market just for a few minutes as something that moves up and down, right? Now, a lot of the techniques that professional traders actually use do not rely on left to right thinking. Right? They rely on this. So this is the depth of market with limit orders here waiting patiently to be filled, and market orders that actually got executed in the middle, right? We've got the prices here and the volume at each price on the left. And when people see this for the first time, they're often kind of shocked, right? It's like, what is this? How could somebody trade just with that? There's far too many numbers, and I'm a visual guy. I want to see a picture. Well, the upside of this is you don't actually read all the numbers, right? It's basically how it flows up and down. And the other thing is it isn't more advanced, right? It's not some sort of technique that only high IQ traders could pick up. And it's at the absolute opposite of what people think. Actually, take on guys. There's one guy they've got now, Joe. They took him on when he was 18, and he's already had 6-figure days, right? So they take on people that have never traded before, and this is where they start them off. This is the beginner stuff. And it's simply looking at the markets as something that goes up and down and applying relevant techniques to that style of thinking. So to give an example, I'm not going to get yes or no. I'm not sure if I can see the replies. I presume most people will not know the answer to this, but does anyone in the audience know what a pole dancer is? I'm not sure. Maybe Marissa does. I'm not sure. But what we're going to do is we're going to look at a pole dancer analogy. So Jim, that's where his money goes. Okay. Well, it's better than losing it trading. Right. So I carefully selected this picture of a pole dancer to not be offensive. So here's our pole dancer, right? And during a set, that dancer is going to go up and down the pole, right? Over time, you could plot the movements up and down and create a chart with time at the bottom and the height on the vertical axis, right? You could actually plot that chart, right? Just the way you do with the markets. And on that chart, you would no doubt see some double tops, either that or the unicorn gets its horn stuck in the ceiling, right? So let's say you watch this lovely unicorn over time. You plotted the results, the moves on the chart over time. You've got the chart in front of you. What is the chance that you can accurately predict which direction the unicorn will go in next? Is it feasible? Is it reasonable to assume the chart's going to tell you where that, which way the pole, or up or down the pole they go next? Does anyone think that's reasonable? Nobody wants to answer that question. Okay, so there's going to be mixed feelings out there about this because people love their charts, and I'm kind of questioning that. Some think this is just not relevant to trading, right? Some will think Fibonacci or WD Gann will predict the moves up and down the poles. But how about this for things that will predict the direction on the pole, right? What if our unicorn's favorite song comes on and they've got a special unicorn routine for it? We'll be able to predict that, right? What if a customer, this is actually personal experience, by the way, what if the customer accidentally throws a wad of hundreds, or whatever currency unicorns use, onto the stage by accident, thinking he was throwing a wad of singles, right? Pretty sure unicorn is going down to collect ASAP. Now, what if some drunk guy climbs on the stage? Unicorn may go up the pole to avoid the grabbing hands while the bouncer ejects the customer. What if there's a power cut? What if the music stops playing? What if the pole starts wobbling, right? There are things that are external to that chart that we can see and will actually predict, a move, right? Some because of a short-term reaction, like the $500 on the stage that needs collection. And sometimes, out of the blue, the unicorn ends up on its colourful behind because the new cleaning lady used WD-40 to clean the pole, right? So this up and down thinking, it's not about being more difficult. It's just thinking about the market as something that goes up and down, which it genuinely does, and trading it that way, right? The reasons may be within a chart or they may be outside of a chart. So this type of thinking is also about using less information to make a decision on the future short-term direction, which is basically up, down, or sideways, right? So the less information you use, the more consistently you can make decisions. But there is a middle ground, something we call the footprint chart. So it's a bit of sideways thinking and it's a bit of up and down. Now, not all prop traders use this. Some find it beneficial, some just use the depth of market. Different traders do different things. So what it shows is it shows where price went, like a candlestick chart, and it shows how much volume we traded at each price. Now, there's footprint charts out there that look like NASA built them with so many different numbers above and below. They look like the cockpit of the space shuttle. So keeping our up and down heads together, let's keep it simple and not get caught up in thinking that adding more complexity to a footprint chart makes it easier to make a decision, right? So if we step back one slide, right, that's up and down thinking, right? Okay, I can see that some people will have difficulty with this. come back here, people will have a little bit more ease interpreting this. And you know what? This might just be your stepping stone to using depth of market. Right, now, as you see, we've got this area up here where we've got a lot of volume at 2 prices. And basically that was the end of the move up. So you think, wow, these charts really work. But like, you know what? People do cherry pick charts, right? So anybody can cherry pick a perfect chart. So let's look at how this same move looks on 2 charts, the candlestick and the footprint, right? So first, this is the same side by side. This bar is this bar. And you can see we just opened the overnight session, and also I'm about 12 hours ahead. So this is 5 p.m. US, 5 a.m. where I am. We can see market in a sideways to upwards move. Really nothing to get excited about. Last candle on both charts are the same candle, but showing different information. So on the candlestick chart here, we can see, a little bit higher volume, but nothing significant there. On the footprint, we can see, we moved up and significant volume hit, but again, really not enough where you'd say, well, I'm going to sell, right? That is not a sell signal, but it is piquing your interest. It's like, okay, why did we get all those sellers there? We still moved up a little bit, but it's piqued our interest. It's saying, something might be going on here. So it's an additional depth of information. You've got like superficial information on the left, and you've got depth of information on the right. Now, if we get to the next candle, we can see a red bar. We can see the volume is a little higher. We haven't broken the session low or any other level, but it is a bigger down bar, which we would have witnessed as it built. We wouldn't have witnessed it instantly, but as it got bigger, we'd have seen it. On the footprint, what happened, we traded another 2 ticks above this high volume level, right? Predominantly on the sell side. And then the market broke down, right? So we pushed up by 2 ticks, just like we did the previous bar. And then we got this drop, very, very little volume, which we will touch on shortly, the significance of that. And there's a good argument here for an entry short below this area, to have as like a stop order to sweep you in as you go below that order. There's also a good argument that says you can now start to stalk the short side because you can see that the market's reversed. Whereas here, this is just a red down bar. Here you can see a lot of volume at the top, and then the market broke down. And it moved quite a few ticks with nobody wanting to touch it, right? So it's a different dimension of information. And in fact, you could play this to the long side or the short side, right? If you said, I want to trade this to the long side based on this volume here, you put a stop just below where that volume is. If you want to trade it to the short side based on that volume, you put a stop just above. So you don't have to be right all the time, but it can give you good risk-reward scenarios, right? Okay. So, left side, right side, do we see the kind of benefit of that additional level of information? Does anybody see that could help, be beneficial in trading? Somebody give me a yes. Yes. I love yeses, thank you. I just want to know you're awake. Right. But before we see this as the new best thing since sliced bread and throw out everything else you're currently using, let's just have a look at the pros and cons. So first, biggest advantage is that it has you thinking about more than just the surface of the action. Like judging a book by its cover, or buying a car because it has a good paint job. Right, there's things going on below the surface that matter a little bit more than the superficial initial view. Right, sorry, that matter more than that superficial initial view. Second, it's just an information tool. So just like the DOM, it's going to help you track activity as moves progress, and that's a big part of what we're talking about today. Now, third, as you'll see shortly, you'll see entries that don't appear on the chart, where you aren't getting in where everybody else is or putting your stops where everybody else is either, right? So it gives you different entries because you're using slightly different information. Now, on the other hand, you can get caught up in this kind of time frame trap, which a lot of people are in now. So I can tell you with absolute certainty there is a perfect time frame for footprint charts that you can discover at the end of every trading day. So at one trading day, you might look back and say, man, that 5 minute would have told me everything, or that 10-minute would have told me everything. There's always going to be one that would have given you absolute clarity, but you just have to get used to using one time frame, and it will be imperfect, but just get used to reading the footprint and stop trying to tweak it and perfect it, right? And it doesn't mean you can only make money when the time frame aligns perfectly with the day's action. It just means you shouldn't go around in circles a lot trying to find the perfect periodicity for every day, because it doesn't exist. It's like any trading information tool. You work with it. You don't have to spend days or weeks tweaking it. You don't have to keep looking for different tools and add-ons to kind of give you more information to fix your decision-making process, because all you're going to do is spend your time looking for new techniques, new tools, and less time actually focusing on getting good at it, right? So take the tool and work with it. Don't turn it into the cockpit of Concorde, like you're only trying to figure out whether the market's going up or down. So, the setup. What we're going to talk about now is a zeros trade. You'll get more information on this trade later on. This is a trade that they use on the trading floor at Axia Futures. Right now, this is relevant now. This is not some old trade that's been thrown away or given to you because it doesn't work. Right. The red arrow here, that is the tell. This is where we know that a condition has been created in the market that gives us an opportunity. It's a short-term opportunity to the upside. And the two lines here, these yellow lines, they denote the area of that opportunity where you can get in, where it should hold, right? Blue area here shows us where we'd probably get in. Now, where does everybody want to place a trade? Down here, right at the bottom. So you can get into a position where you can put your stops right below the bottom, just where everybody else's stops, so you can all get stopped out together, right? So everybody wants to get in at the bottom. So let's look at the footprint chart at this area and see how it gives us a setup, right? Now, I'm going to say, if you're not used to footprint charts, this is going to be a little bit new to you and a little bit hard to read. But let me just show you what we can see, right? So we can see the market went down and it kind of moved sideways in a range, and we finally broke up. We finally broke to the upside, and that means there's a decent chance the path of least resistance is to the upside or it's a new uptrend, right? Now, look at the numbers on this particular footprint here as we popped up. The zeros on the left are the sell orders, the sell market orders that hit limit bid orders, and there's almost none of them, right? So this is what's known as a zeros trade, because you're looking for those zeros. A trade you could take on the depth of market or the footprint, and it's more of a preference that's personal to you on which tool you use rather than one being better. Now, the numbers on the right are how much buying or how many buy market orders it took to eat through each offer to move up. And it's actually quite low relative to other numbers everywhere else. Now, what we're seeing is, a lack of sellers. But to be sure, to be clear, for a trade to occur, you've got to have a buyer and a seller. So on the right side, you can say, yes, we match buyers and sellers. Market buys hit sell limit orders here, but the sell limit orders are on the high side. They kind of got out of the way, right? So the sellers on that side were getting in the way. So sellers bailed at this point. There were no sellers hitting market orders. Sellers bailed at this point, and this created a zone, an area where sellers didn't engage. So is this a guaranteed trade? Absolutely not. Is it good risk reward? Yes. Because if you see aggressive selling below this yellow line, you are out, right? You can bail out a small loss, right? So what we see is we actually come down and test this area twice, right? And that's effectively where your entry is, right? Your stop loss is going to be a little bit below the yellow line, and depending on the market, you're going to give it a little bit more leeway. If it's the DAX, a lot more leeway. If it's interest rates, not so much leeway. So what you're going to be looking at is how they attack the market below that line. If there's a couple of contracts, you don't have to worry about it. Major selling, you get out. Now, interestingly, we haven't entered at the low. We've entered at quite a dull area in the middle of a move, and it's not an area worth nudging around, because you know what? There's not a lot of positions there. So when you get in at a low, there's kind of an incentive for somebody who manipulates the market to push the market against you, to stop you out. When you enter somewhere like this, there's nobody to push out, right, initially. Okay, there will be when you get in, but generally speaking, it's not one of those zones where we see nudging around, right? So if we move on, we've got our zeros here, slightly different format footprint, I apologise. You've got your zeros here, and you can see how far we've got so far. So we now appear to be in a range. And there's a few things to consider. Now, downside on this trade is easy to figure out, right? If you see a lot of selling and price moving against you, it's over, right? Another consideration is the way institutional positioning works, right? So if some big news hits the market, like when 9 months ago, we had some missile attacks on Saudi refineries. That was a big day for oil. But even the people that need to get into the market to react to that, hedging or whatever, let's say somebody needs to buy 10,000 contracts. They can't just put in a single market order for 10,000 contracts, because they'll just move the market and get terrible prices, right? It actually guarantees them bad prices. So they're going to work their way into a position, trying not to move the market too much as they go, but they can't not move the market, but they're trying to not move it too much. And it's one of the reasons people look at VWAP, because that's a benchmark of value that changes over time. And if you get prices below VWAP, you did well, right? Well done to you. So there's going to be an ebb and flow. Even when you're looking at institutional volume, it'll ebb and flow. It's not going to be just a constant stream of buying. So in this case, we did move up and we've developed into a range, right? Now, there's a good argument for working your way out of this position because it's been moving sideways for an hour, okay? And here's your dilemma, right? So for me, if the market's in a range for an hour, I'm out, right? If the market's in a range for like 10 minutes, I love that, because that to me is just a little pause in the activity. But here's the dilemma, right? If this range breaks, what's going to happen? We're going to get a stop run and it's going to move to the upside. But realistically, it's been moving sideways for 2 hours, and to me, it's just run out of steam. But think about it, right? If you look at the top of this range and you say, right, I'm going to get out at the top of this range, what you really want to know is, are they attacking the top of that range, and is it going to break? Because if so, I want to be a part of that, right? So it's a great level, but the thing is, there's one or two things that are going to happen at that level. It's going to hold or break. And you want to be able to be in when it breaks, right? Because it's going to break and it's going to be a big move, right? So shorter term ranges are good because it gathers positions, and then when the market continues, we'll see a nice pop our way. But also, it doesn't have to be an all-in, all-out thing, right? So when you see something like this, you could add to your position on the way in, and then when you see the market move sideways, you can take some profits, but you can keep some of the position on. And that's what professionals do. If they're not sure, their position size can ebb and flow as the market pushes up and eases off. So you might see a range like this and take some profits, then scale in if it moves your way again. But obviously, if a market moves in one, market sticks in a range for 2 hours, this move up is done, in my opinion. Now, here's a good example of typical stops and targets, right? Same area, right? So first of all, for those of you that trade double tops, at one point this was a double top, 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 right? So you look at double tops, you can see them, but you look at this as a trend. But these are all failed double tops, right? So typical stops and targets, typical stops are basically under the last swing, right? And typical targets might be the old high, and you might hold some for a new high, okay? The issues with the lows, we should know before it hits that low if there's a lot of participation to the downside, right? That's what tells us it's going to go through the low, right? It's not just, oh, the price is there, I'm going to put a stop underneath it, okay? The issue with the high, well, that's an area that if it breaks, you're going to get a big old continuation, right? Like any high, really. So if you were looking at this high, you'd have lost out on this move. And if you're looking at, maybe maybe you got in here and looked at this high as a target, you're going to miss out on this. And that's the problem with these targets. When they break, they actually give you much better moves. It could stop, but you generally see some stops fire and get a continuation. So it's not just a silly target, it's just that the upside is so big if it breaks. So, you can see all the pushes up on these charts. Like I say, every one of those would have been a double top for a short period, a potential target. And like I say, when you look back historically, it just doesn't stand out that those are all failed double tops. Now, the worst place you could ever put a target is one tick above the old high, okay? Which basically means you expect the high to break by one tick, but generally speaking, if the high breaks, it's going to run more than a single tick, right? So one tick above the high, that's a terrible, terrible target. Right, another way to put this is that the best targets are the worst. So if your target is really good, and by a good target, I mean an area that lots of people are looking at, there's going to be one of three things happen, right? First, you're not going to get to your target, in which case you're going to let the market come back to your stop, or hopefully you won't. You'll see in the footprint that actually that you moved over. It could get there in reverse at that exact level, which means you're right and you're brilliant and you set a good target, right? Hopefully you got filled too. Or it blows through, causes a stop run and continues. Now, if you think about it, the ability to be able to predict which one of those things would happen ahead of time based on nothing but a mathematical continued calculation or an old price point or whatever, well, to me, that is one hell of an advanced skill. To be able to predict exactly where a market will reach, that is an amazing skill. In fact, it's so advanced, I have never met anybody that can do it. Right? I know a lot that try on a daily basis, but I've never met anyone that can do it. So if you can bring in a bit more depth, you can have a target by all means, but you need a way to know if it's going to get run over. So you can actually make more out of the move. Now, what are the best non-predetermined targets, right? And we will teach some more about this later. The best non-predetermined targets, market runs out of steam, size disappears, right? And it's all relative, right? So, on one day you might have a big move where we're trading 100 lots, and another day big size might be 50 lots. So it's kind of situational to each day, but just the size disappears. The players disappear. So you might have a target above, but there's no way it's going to get there, and you get out preserving the profits that you did make. Another non-predetermined target is a blow-off, where basically, and you'll see this on crude 3 or 4 times a day, market's moving up and then suddenly it just shoots up to the sky. Everybody believes that the market is now in a move that will last forever, right? And that they are seriously missing out. So what they do is they finally can't hold off anymore and they buy, and they find out that they just bought the top of the market. Typical fear of missing out. So those market blow-offs are also very good signs to get out. Another one, market trades against you very aggressively. So if you see a lot of aggressive trading against you, you're probably done, right? So these are the best targets. Now you can mix the two, right? There's no reason you have to stop what you're doing to start putting this in place. But so how do you get started with this? So I'm going to tell you our plan for how you go from not knowing any of this to getting to the point where you can use this in your trading effectively. So here's our plan. It's a 7-week plan. Week 1, you're going to need a trading platform, and we have a trading platform. It's a unique, award-winning order flow oriented platform. So it's focused on the techniques used in modern day proprietary trading firms like Axia. It is not based on the 50-year-old trading books you find in Barnes and Noble, right? It is not based on any of that. So for many, your first step is actually going to be our Order Flow Primer course, which actually comes with the platform. Okay, so what that does, we're not going to presume you're ready for footprints. We're going to teach you the theory of order flow without throwing a lot of jargon and terminology at you. And there's people here that have taken this course, and it's going to explain the mechanics of price movements and various ways to use order flow both in trade entry and management. And this is the most widely recommended order flow introduction course anywhere, and it comes free with our platform. Now what we're going to do, we're going to have a live session on the 19th just to make sure everybody's set up and ready to go. And then I'm going to tell you on that day exactly where you should focus. And it's not much education, but it is a fair amount of drills, like hands-on stuff. I don't want you to watch the whole 10 hours. You can catch up with some of it later. Then we're going to do a live session on 23rd, right? And what we're going to do is we're going to go over the order flow concepts and ensure that everybody understands it before we move on, right? Now, during that time, you'll have access to our chat room, analytics, and if you get stuck, you can just get in touch with me on Skype. Right, week 2. This is the first part of your footprint-specific primer, right? So you're going to get 3 videos delivered by one of Axia's professional traders. Now, this is a professional trader, and is a trader that's quite famous for using footprint. He uses it very heavily in his trading. He's been consistently profitable using footprints for the past 7 years. Now, I'll tell you, 1 and 2 are available publicly, right? Part 3 isn't, and that is the part you need to understand the key patterns created in the footprint so you can recognize them, understand what it means in terms of the underlying activity and the trend in the market. Right, that's week 2. Week 3, we're going to give you 3 footprint strategy videos. Okay, 70 to 90 minutes. We didn't add it up. Again, these are 3 footprint strategies from the Axia trading floor that they use today. Right, these are strategies that you will not find anywhere else. Now, as well as that, every week during the 7 weeks, we are going to send you, actually it's 2 to 7, we're going to send you a 1-hour video giving a deep dive into that day's action. Again, it's going to be from one of the professional traders, and they're going to talk about the trades they actually took on the floor. And what they're going to do is they're going to walk through the key setups of the day, but more importantly, they're going to show you what was in the footprint that told them that move was over, right? So you're going to get something completely unique every week, right, based on that day's action, so you can actually start to understand how people are executing this live. At the end, we're going to round it off with a live masterclass with one of Axia's elite traders. And partly this is basically, you know, rounding off the knowledge and giving you kind of the final extra little bits. But this is also where you get to interact with a proprietary trader, somebody who trades for a living, and go through a bunch of Q&A. Now, I don't want you to ask him how much he makes for a living. I don't want you to ask him what kind of car he drives. I would like you to ask him stuff about footprints. And that will help to kind of finish off your education so you're ready to go forward. Now, you can't find that package anywhere else. And sure, there's lots of courses out there, but there aren't courses out there delivered by traders that have 6-figure and sometimes 7-figure days, right? So this package takes you on a journey which will put you head and shoulders above your fellow traders in terms of market understanding, setups, and trade management. Now, we could give you all of this in 1 week, but you know what you'd do? You'd go through all the videos in 1 day and none of it would sink in. And that's the reason we're spreading it out, right? We know retail traders, right? Now, you're going to get an outstanding platform designed for people using these techniques, not the stuff in those dusty old books about moving averages you find in your local bookstore. This is current stuff. And on top of that, you're going to get lifetime access to our platform, our chat room, our trade analytics. But more importantly, as people in here will attest, we make ourselves available. You know, I'm not saying you can pop round my house for a cup of tea at 3 o'clock in the morning, but you can Skype me. And there is a way to book an appointment with me, which you don't have to pay for if you feel you're just struggling and you're not getting anywhere, right? That's just something we do because it helps us develop, it helps you develop, and it helps us keep in touch with traders, right? We talk to people at Axia a lot. We can't just talk to them. We need to talk to people on the other end of the scale. So if you kind of look at us, we're like a bridge between the professional and the retail guys. Now, the value of all this is actually, it's a bargain at $4,000 because you're going to be taught by professional traders using the techniques they use today, not rehashed technical analysis techniques that died out 20 years ago. And I'm sure you all see the value in learning from current professionals, right? Now, the question is, would anybody like a discount? Because I tell you what, if there's one trait of a good trader, it's wanting to get something cheaper. So would the next slide, anyone want to see the next slide where the price goes down? Or I can just leave it here and leave it at 4K. Yeah. So what we're going to do for the next 20 people, we're going to leave this up for 48 hours. You get the package for $997. That is a massive discount, right? We're going to run it 48 hours only, or the next 20 people, whichever happens first. After that, it's going to go back to full price. It's just really for this event. You know, Marissa is brutal, absolutely brutal at getting us to put deals like this together, right? I mean, she's absolutely brutal. You know, I'm a little bit scared of Marissa, I actually have to say. So, you know, if you're truly interested in learning how to trade, so that you have the best possible chance of making trading your main source of income, come and learn from the people who make their money trading every day. And with that, I will open up for questions because I think I've still got 3 minutes. I can see one. It's not web-based. Okay, so Jigsaw Trading Platform is partly web-based and it's partly Windows-based. The depth of market and the things that really need to be performant run on Windows technology because it needs to for the performance, for the threading and all stuff like that. Other stuff like the charts, newsfeed, that is cloud-based tech. So it's basically a hybrid system. If you've already got a lifetime license, give me a call and we'll just drop me an email and we'll sort you something out. And even if you haven't, and you know, even if you've been with us for a while and like you say, you're interested in kind of bringing your Jigsaw back to life, absolutely fine if you want to just email me. When does the footprint come out for Jigsaw? We're going to put it out on that day. It's on the 27th when we do the footprint workshop. We don't want to put it out before then because we don't want the people on this course to be playing with footprints ahead of time. Everybody gets so excited about stuff and we're really trying to make it like a 7-week program where like this week we want you to focus on this, next week we want you to focus on this, because you know people cram and it doesn't sink in. Yeah, you can contact us from the members site. You know, there's a little chat bot on the members site. Just get in touch there. And I believe Marissa very kindly put the link up. Yeah, the zeros trade will be included in this. And we'll also, obviously, in the weekly sessions, that's where we're going to really focus on the exits, Miguel. So that's part of the weekly sessions. Yeah, there's going to be data box, cumulative delta. We're adding a lot of stuff for the charts, but really today we wanted to focus on footprint. You know, a lot of people look at the depth of market and it scares them a little bit. And this is, you know, footprints are things that we know are used by professional traders. So we're quite happy including them in the tool. But we kind of like to think they're going to be a stepping stone to the depth of market. Can you overlap footprints with market profile? I haven't tried it, but you should be able to because they're all just charts. Yeah, well, let me just clarify on Joe. Joe started at 18 and he now has 6-figure days. He's 23 now. But they took him on they took him on straight from school because he was really bright. The DOM is same as level 2, but it's just slightly different from futures and stocks. I think with that, Marissa, I'm 16 seconds over and I don't want your waters to break because you're getting stressed. Are you still there? Or maybe she's been rushed off.
I wanted to leave you in suspense that I had my baby, but
yeah. Is he a boy or a girl?
But no, I'm here. I'm sorry.
Yeah, so I think we're good with the questions. It's a great course. It's a good offer. I had to twist Axia's arm for this, and Marissa twisted mine much harder. I really appreciate you all listening, and good luck with your trading, whatever you decide to do.